Today we will introduce the background and context of sovereign debt crisis, which occur when governments are unable to meet their debt obligations or borrow at affordable costs. Such crises often lead to default or debt restructuring and can seriously disrupt the entire economy, affecting banks, businesses, and ordinary citizens.
Historically, sovereign debt crises have occurred many times, including the Latin American debt crisis of the 1980s and the European sovereign debt crisis between 2010 and 2014. The 2008 global financial crisis played a major role in triggering the European crisis as governments rescue failing banks, transferring private losses to public debt.
Good afternoon.
Afternoon, boss.
Sit down. So today, our discussion is focused on how sovereign debt crises affect firm, investor, and national economies. We will begin with the key concept of frameworks, followed by real evidence, impacts on stakeholders, and finally, a comparative evaluation. Let's start with the theoretical foundation.
So certainly, boss. So the sovereign credit risk is transmitted to a non-financial firm mainly through two mechanisms, which is the first one is fiscal channel and second one the financial channel. So the fiscal channel occurs when rising sovereign risk force government to adopt stricter fiscal policies such as higher taxes or reduced subsidies, which directly increase firms' operating costs. So the financial channel arises when banks holding large amount of sovereign debts experience balance sheet and also leading to higher funding costs and restrict credit supply to the firm.
Okay. So how strong is this relationship empirically?
So the strong relationship is the empirical evidence from the ECB shows that 10% increases in sovereign credit risk leads to a 1.1% rise in corporate credit risk, and also demonstrating a clear spillover from sovereign spreads or CDS to the corporate financing condition.
Are there broader international finance frameworks that have explained these dynamics?
I think yes, because the traditional international finance theories such as interest rate parity, capital mobility, and also purchasing power parity (PPP), and also exchange rate channels explain how higher sovereign risk trigger cross-border and capital reallocation and currency pressure affecting firms exposed to the foreign financing. So these macro frameworks are operational at the firm level using different indifferences (DID) models, as shown in the Bank de France working paper.
All right, good explanation. So thank you, Naim. So cool. Can you walk us through the real-world evidence on sovereign debt restructuring?
Of course, the Bank de France study examines sovereign debt restructuring from 1956 to 2023 and links them to over 100,000 firms' observations. The finding shows that rapid and well-coordinated restructuring, particularly those led by official creditors like the Paris Club or Chinese programs, increased firm sales growth by 5 to 9 percentage points. This restructuring reduced uncertainty, restore fiscal space, and improved credit conditions for firms.
What happens when restructuring are slow or poor coordinated?
In such cases, the gains are significantly weaker or even absent. Delayed or creditor fragmented restructuring prolong uncertainty and delay policy stabilization, which negatively affects firm investment and recovery.
How does it compare with evidence from the Eurozone crisis?
During the Gypsy crisis, 2009 to 2012, research shows a clear divide between firms. Unlisted, bank-dependent firms were forced to deleverage due to tightened bank credit, while listed firms with market access maintained or increased leverage. Ownership structure also mattered, as listed family firms could buffer shocks better than unlisted ones.
Now, Nisa, how do this issue affect multinational firms and investors?
Sure, boss. Sovereign debt restructuring significantly shapes the business environment. Successful restructuring improves fiscal stability, reduce uncertainty, and enhance private sector performance. Multinational firms benefit from improved infrastructure, utilities, and financial system when government regain fiscal space, making host country more attractive for investment.
What about periods of rising sovereign risk?
When sovereign risk increase, the negative effects spill over to corporation, especially firms closely linked to governments or relying on bank financing. Borrowing costs rise, financing becomes uncertain, and investors demand higher risk premiums or withdraw capital altogether. At the national level, banks holding large amounts of government debt transmit stress across the financial system. tightening credit, and slowing economic growth.
Can you relate this to the gypsy experience?
Yes, in Gypsy, as we all know, Greece, Italy, Poland, Spain, and Ireland countries, heavy reliance on bank financing meant that sovereign stress caused a dramatic decline in lending. Multinational firms and investors responded cautiously because they dried up and economic recovery became more difficult, reinforcing a negative feedback loop between public debt and the real economy.
Finally, let's evaluate this comparatively. Anis,
Yes.
could you compare the impact of listed and unlisted firms?
Listed firms generally perform better during sovereign debt crisis because they had access to capital market, allowing them to issue equity or bonds even when banks reduced lending. In contrast, unlisted firms which rely heavily on bank loans were forced to deleverage when credit tightened. Evidence from GEC country shows that unlisted firms in Greece and Portugal faced severe constraints, while listed firms in Spain and Italy were more resilient.
How did banking system strength influence outcome?
Countries with banks holding large amounts of sovereign bonds, such as Greece and Portugal, experienced sharper credit contraction. Banks weakened balance sheet for firms, especially unlisted ones, to delay investment and scale back operation. In contrast, Spain and Italy had relatively more diversified and resilient banking system, reducing the severity of credit spillovers.
What role did government policy responses play?
Policy choices were crucial. Strict austerity in Greece and Portugal worsened recession, increased bankruptcies, and strained banks further. Meanwhile, Spain and Ireland adopted more balanced fiscal adjustment combined with financial sector support, allowing firms to recover faster. This comparison showed that sovereign debt crises are not only financial events but also policy-driven outcomes, where well-designed responses can mitigate damage to firm and the broader economy.
Good evening, everyone. Sorry for the sudden meeting. Sit down, sit down. So for this session, we will discuss about the main finding, lesson learned, recommendation, and also personal insight from our analysis on sovereign debt crisis and international financial challenges. So let's begin with the key finding. So Amirul, so what are the main findings from our analysis regarding our sovereign debt crisis?
Our main finding is that a sovereign debt crisis affects not only the government, but also banks, firms, investors, and the entire economy. Sovereign risk and corporate risk are closely connected, and weaker financial system and policies make the impact more severe, especially for firms that rely heavily on bank financing.
So how does debt restructuring affect the recovery?
Debt restructuring helps recovery when it is done quickly and in a coordinated manner. Faster restructuring allows banks to resume lending, improve firm access to credit, and supports the recovery of business, sales, and economic activity. In addition, listed firms with access to capital markets are more resilient than unlisted firms that depend mainly on banks.
I see. So are there wider economic effects?
Yes, the effects spread across the whole economy. A loss of investor confidence leads to capital outflows, weaker currencies, and higher import costs, reduced consumer spending, and declining sales, which together destabilize the entire economic cycle and affect both businesses and households.
So thank you, Amirul. Next, Mira, what key lessons can we learn from this issue?
One major lesson is that sovereign debt problems are closely linked to the real economy. They affect businesses, workers, and foreign investors directly. Relying too much on bank-based financing is risky because when banks are under stress, many firms suffer at the same time.
So, Amy, what role do government action play in this crisis?
Government policies are very important. Fast action, proper debt restructuring, and financial sector support can significantly reduce damage and help recovery. The issue also highlights the importance for investors and multinational firms to carefully consider sovereign risk before entering a market.
So, Amy, is there any broader government lesson from this crisis also?
Yes, transparency and trust are crucial. Crises often worsen due to delayed decision and poor communication, which cause panic among investors and the public. Strong governance, financial discipline, and long-term planning are essential to prevent repeated crises.
So, thank you, Amy. Next, Ain, based on our analysis, what recommendation can we make from this crisis?
First, for policymakers, they should carefully assess risk and opportunity when designing regulation, as strong framework help protect financial stability and prepare economies for sudden shock.
I see. So, what about the under-investor?
Investors should be cautious and diversify their portfolio to reduce exposure to financial volatility, which is often beyond their control. Diversification helps limit losses during market downturns.
And what about firm? Is there any recommendation on that?
Firms should adopt strong risk management strategy, such as hedging against exchange rate fluctuation and maintaining sufficient liquidity reserve. These measures help firms remain resilient during periods of financial instability.
So thank you, Ain. So finally, Amirul, could you share some personal insight on the importance of managing international financial challenges?
From my personal perspective, managing international financial challenges is important because financial shocks can occur unexpectedly and have serious economic consequences. I believe that early planning, strong financial management, and effective coordination allow governments and firms to respond more efficiently and build long-term economic resilience.
See, so Amy, can historical crisis support this view? What do you think?
Yes, even like the 1997 Asian financial crisis and the 2008 global financial crisis show that delay on Russian decision worsen economic damage. History teaches us that careful planning, coordination, and resilient building are critical for handling future financial shocks.
Thank you everyone for watching our video.
Bye!